In this video, we will be talking about financial statement users and generally accepted accounting principles, otherwise known as GAAP. So our two topics in the video, financial statement users, which include both internal and external users, and GAAP. So we took a quick look in the last video at financial statements, or two of the four financial statements. We looked at an income statement and we looked at a balance sheet. So who uses that information? Or in other words, for whom are we preparing that information? Some of the users are internal users, and by that we mean that the users are internal to the organization. So the financial statements we took a look at were target financial statements, and so their marketing department might take a look at the income statement to look at the relationship, say, between marketing expenditures and sales revenue. The payroll department might take a look at the relationship between salaries expense and what they owe their employees, salaries payable. So these internal users might also use what is known as managerial accounting information, which is information that is prepared only for internal users, but they also are going to use this financial information that is prepared for both internal and external users. So the finance department, management, human resources, the marketing department are all examples of internal users. The other type of accounting information user is going to be an external user. So financial statements are prepared primarily with the interest of investors and creditors, as well as potential investors and creditors in mind. So we talked about the idea that the owners of a business are the shareholders. They invest cash in the business in exchange for shares of stock, and they want to know what's going on with their investment. On the other hand, there may be individuals or institutions who are thinking about investing in the business, or potential investors. They also want to know what do the cash flows and income of the company look like, what are their resources compared to their liabilities, and so on. The other primary type of external user is creditors, or companies or individuals who are loaning money to the company. So if the company has a loan from Bank of America is the creditor. If the company buys goods on account from Apple, essentially they buy the goods and they charge them, then Apple is the creditor in that situation. Customers might also be interested in financial accounting information, and we briefly discussed the Securities Exchange Commission, which is a regulatory authority that is also interested in financial information of the company. So let's say that we are considering making an investment and we're looking at Target's financial statements and we're looking at Walmart's financial statements, and we're trying to figure out which one of those looks like it would be the better investment. Well, in looking at those financial statements, we need to be sure that they're prepared the same way, that what Target is recording as revenue and expenses is recorded in the same way that Walmart records revenues and expenses. So the Securities Exchange Commission, the government regulatory body, requires that they use the same basic set of accounting rules, and we refer to those as generally accepted accounting principles. So these are essentially the guidelines, rules, concepts that companies have to follow in preparing financial statements. So if you are a publicly traded company, remember that means that your shares are traded on one of the organized exchanges like the New York Stock Exchange or the NASDAQ, then you are required to use generally accepted accounting principles. And one of the many things that GAAP does is that it ensures comparability between different companies' financial statements. And specifically, that means that they're calculating net income in the same fashion. They're presenting their cash flows in the same way, and so on. So the SEC does not create generally accepted accounting principles. They are created by a non-governmental private standard setting body known as the Financial Accounting Standards Board, or the FASB. So another example, you're considering investing in the stock of either Bumble or Hinge. They are both publicly traded companies. Bumble is traded under BMBL, and Hinge is part of the Match Group and is traded under MTCH. So in comparing the two companies' accounting reports, GAAP ensures that they are prepared using the same set of rules. So a couple of examples of GAAP. So talking about target recording revenue, we went through a brief example in the previous presentation where we said that Target would record revenue at the point of sale if you went in and you were checking out with the Diet Coke and an Xbox game. So in recording revenue at the point of sale, they are following the revenue recognition principle. So the principle dictates when a company should recognize revenue. In some cases, like my Target example, it's super straightforward, but the rule actually states that revenue should be recognized when a performance obligation is satisfied. For many companies, this means point of sale or delivery of service, but it can be considerably more complicated like that when you have bundled goods and services. Another example of GAAP is the expense recognition principle. So in talking about my Target sale in the previous presentation, I said at the same time that you recognize the revenue from the sale, you would also want to recognize the expense or Target's cost of the goods that they sold. So the expense recognition principle dictates when expenses should be recognized, and it's sometimes called the matching principle because it says that expenses should be matched against the revenues that they generate. And so when we recognize the sales revenue, we would also want to recognize cost of goods sold, which is the expense associated with that.